Okay, let's take a look at what would happen to a purchase of a put, and let's purchase an at-the-money put. The 54 strike price put is at the money. And let's go directly to our trade termination date, which is July 7th, and see how well we did or lost. In this case, we lost $131. So very similar. If you're wrong, obviously, you're going to be losing money on a purchase of a put when the market rallies strongly. But if we take a look at our early termination date based on our stop loss, which was June 27th, we only lost $77.50. So those are the scenarios for purchasing an option. Obviously, the best dollar gain that we received was an in-the-money call option during that period. The next best gain was an at-the-money call option. We can also take a look at the gains potential for an out-of-the-money call option. Let's take a quick look at that. Let's say we thought, yes, in fact, we were right. The market is going to rally strongly. We wanted to take as much advantage of that gain as possible, and being, we wanted to gain as much money as possible. So we decided to buy an out-of-the-money call option to take advantage of that gain. Let's say we thought that the market would rise above the 57 level, and we wanted to buy something very, very cheap. So we decided to buy the 57 call option at the strike price of 57. And let's go directly to our end date, which was July 7th, and see how we did. We gained $221. Now, on a percentage basis, that's a huge gain. Purchasing an option for 18.5 cents and then making $221 on that with the option itself rising to $2.43. So that's a fairly good gain. That's an excellent gain. But in dollar terms, it doesn't even come close to our in-the-money call option. We gained $221 versus $509 for our in-the-money option. And so you have to decide whether or not, if there is a strong rally coming, are you looking for percentage gains, or are you looking for total dollar gains, and the money that you need to allocate to that position, is the gain worth the extra risk? Because out-of-the-money options, remember, will expire totally worthless. And as we get closer and closer to expiration, not only is the delta smaller, so your actual dollar gains are much smaller than in the money option, but also as you get closer to expiration, the more money you will lose eventually, because you get closer. And remember, all options that are out of the money expire totally worthless. All right, now let's also take a look at selling options. As I mentioned, you can both buy options and you can sell options. If you decide that you're going to be selling options and you think a rally is coming, the best place to go and sell options is in the puts. You want to sell puts. You don't want to sell calls if you think a rally is coming. In our case, what we want to do is take a look at the puts. So we're going to take a look at the put chain. Now, there's many different options. We can sell in-the-money options, we can sell at-the-money options, and we can sell out-of-the-money options. In almost every single case, you're probably better off, as far as dollar gains, by selling an at-the-money option. If you're looking for a bit of a safer trade, if the market happens to go against you, you'd lose less if you sold an out-of-the-money option. And normally when I do an out-of-the-money option, I'm looking for a delta of between 22 and 25. So in this case, we'd probably sell the 51 strike price option. We sell it for 52.5 cents. And let's go now directly to our termination of our trade. and see how well we did at July 7th. We would have gained $52. At this point on July 7th, even though we still have some time before expiration, because the delta had basically gone to zero, we would have exited that trade already. Once delta goes below 5, a 0.05, there's very little profit left in that trade. In fact, if we started to go back a little bit in time here to the 6th, to the 5th, to the 4th, to the 3rd, to the 2nd, to the 1st. Let's go back even further to right about here. When that delta on June 29th, that delta dropped below 0.05, I probably would have exited that position. Let's see what our profit would have been on June 29th. Remember, if we held it all the way to our termination date of July 7th, we would have gained $52. Well, on June 29th, we have a profit of $46.50. So we lost about $5 by not holding it through to July 7th. However, once that delta drops below 0.05, there's really not much profit potential left. In fact, there's only $5 of profit potential left in that position for a single contract. So, you know, it's if the profit potential is really diminished, then you probably want to exit that position and get out of it and take your profit of $46.50 per single contract.